It's December, you go to pull them and you can only get back to June or May. And so I do always start there. I think the exchanges have gotten better where you typically can get that history of between, a year or beyond. And then your wallets, obviously, those don't typically have any history cap. So usually you're okay there. So it's the mining pool reports I definitely key in on, especially for businesses, because that's going to be kind of your main source of support for revenue. And it goes beyond just your taxes, right? If you have audits or internal accounting, those reports are huge. So I really encourage people, the record keeping aspect, it's tedious. It's definitely the least fun in assessing your picture, but you're going to want to get all those reports in order. And the sooner you pull them, the better.
Welcome back to the Compass Mining Podcast. My name is Jarrett, and today I'm once again joined by Nick and Noah from the network firm. And before we dive into the episode, I just want to shout out that Nick and Noah were on in early September of this year. And we talked about a whole host of things that have to do with Bitcoin miners, taxes, things that Bitcoin miners should be taking into account. We also created a blog, which is actually up on the Compass Mining website. So if you want to access either the blog or the original episode, I'm going to leave those links in the episode description so you can go and reference those as you need. What we want to do today with Nick and Noah is basically, it's the end of the year. Let's outline some things that Bitcoin miners should be taking into account as we get closer to 2025, even though taxes are not going to be due probably till April 15th or April, depending upon, and I know sometimes people do quarterly taxes depending upon your business structure, but all that's to say, I know that that's in the future, but somehow it's the end of the year. Somehow April will be upon us, and somehow many of us will be in Las Vegas very, very soon in May. That is how Bitcoin moves. So anyways, Nick and Noah, thank you for hopping back on the pod. How are you guys doing?
Doing awesome.
Good, Jared. Yeah. Thanks for having us.
Yeah, and I just want to shout out, I know that Nick is stateside and Noah is across the pond in what I like to call the Northern Caribbean, aka the United Kingdom. I think he's in London, so thank you for hopping on. Nick, let's go ahead and start. What are some of the things, and I know that we've created an outline to kind of guide us a little bit just because taxes are heavy and these things are, this isn't a normal podcast that, like when I have a guest on and we're talking, for example, Rob Warren, I'll have him on this week, and we're going to talk about his book, The Bitcoin Mining Almanac. That's a little bit, a little bit easier to maybe to talk about than it is to make sure that we are providing people who are listening the proper information around taxes if they're Bitcoin mining. So it's the end of the year, Nick. What are some things, kick us off with what are some things Bitcoin miners need to be considering as they think about tax planning into 2025 and getting ready for that tax event?
Yeah, you hit the nail on the head. It's a complicated topic, and I'll put out the blanket statement that we're going to hit some high level stuff here, but everyone's situation is different. When you're doing taxes, the full picture matters in terms of what you can take advantage of and what you can't. So hopefully these takeaways give you a good start, but just reminding everyone that you'll want to consult with your tax preparer, your CPA, ahead of time to make sure you've covered all your bases. With that being said, I think one of the most important things to start is taking a comparative look at your 2024 profit or income picture compared to 23. And the reason we call that out up front is that, you may have a much different picture. Hopefully you're more profitable this year, but that may mean you've moved up in the income tax bracket category, right? So you may owe more than you did in the prior year. And when that happens, the IRS expects you to make estimated tax payments. You mentioned quarterly tax filing. So this is more of a, hey, I'm going to owe a tax bill come April when I file my return. And if that is over a certain amount or over what you owed in the prior year, they would want you to make an estimated payment. And when you don't, they'll tack on some penalties and interest. So that's definitely kind of your first step.
One good way maybe to kind of, put that into reality or, think about a good example for that would be, I don't know the exact customer segmenting, right, at Compass, but I would assume a lot of folks aren't, 100% dedicated to mining. They're either sort of hobbyist or have maybe even significant investments, but they've got their own business or they've got maybe some W-2 income, so normal employment and they're mining on the side using hosted mining services. Let's say you did that, you started that in 2024. You would have seen a significant change in the price of Bitcoin over the year, right? And so let's say your W-2 income for 2023 was, 120K, let's say, right? you start mining Bitcoin, and you're adding obviously significant income in just the mined Bitcoin. If you're also selling Bitcoin, which I think Nick will get to, right? That when you do sell, again, reminder, that's a capital gain event, either short term or long term. But let's say you're selling some of that Bitcoin as you go, unfortunately, right? For the diamond handed, unfortunately. But you're doing that to pay some hosting bills and keep up, right? You're probably there having a capital gain event in addition to your ordinary income event over 2024. And yay, we're at 100,000, roughly 100K. Round numbers, right? Feels good. We're basically there. But your income picture for 2024 could be significantly different than 2023. And so the IRS basically has something called safe harbor. It's kind of a funny tax term they use. What the heck does that mean, right? It's stormy waters. I got to safe harbors. I'm not sure why they use it exactly, but basically if you're in 2024, if you've been making estimated tax payments on that income, both your W-2 plus your mining income plus your capital gain income from mining. And that's basically 90 or 100%, I believe, of your 90% of your prior year. What that means is if you accidentally underpay, right, when it comes to March, April of 2025, and it turns out, oh, I haven't actually paid. But if you've paid basically 100% of your prior year, you're going to be able to get safe harbor, meaning that the IRS will say, hey, you owe us back taxes, but they're not going to put penalties on top of that, which is something that they often do. So that safe harbor really only just applies to the penalties aspect. But to Nick's point, very important, kind of looking at your year over year picture. And then Jarrett, like you said, a lot of folks that we support, we do quarterly tax estimates for them and they make an estimated payment. It really helps the year end quite a bit, or, the quarter after the sort of tax deadline surprises.
Yeah, and I was just so curious, Noah, as you mentioned that safe harbor, because being as someone who was raised in Massachusetts, we're highly aware of the Tea Party and we're highly aware of the ocean and maritime law. It's something that people will joke about, right? Because people, for a long time in Massachusetts, this is getting way off topic, but maybe interesting. But for a long time in Massachusetts, gambling wasn't legal. But people would take cruises to go out to maritime law,
right.
Go out to international waters, right? And so I was looking it up, and it is interesting. It says the phrase safe harbor originates from maritime law and navigation. In the context of ships, a safe harbor is a place where vessels can find shelter from storms or dangerous conditions at sea. It implies a guaranteed level of protection in the midst of potential risk, which I think is exactly why the tax terminology and nomenclature kind of adopted that. That's a interesting thing. And I saw that in the outline that we want to think about where we were in 2023, compare that to 2024, because as you said, Noah, and you were trying to keep it under wraps, you can be bullish, you can get crazy. It is a crazy time for Bitcoiners. If you've been around the space, especially for miners, seeing hash price continue to go up is a great thing. Also, at the same time, however, difficulty and the hash rate is growing. So the entire ecosystem is growing. Moving ahead into 2023 and 2024, this is just now curiosity. You're saying we have to compare where we were in 2023 to 2024 because things have changed. The Bitcoin price has gone up. If you're a miner and you're having to sell Bitcoin back, which, diamond hands, it's not necessarily a paper hand if you're doing it to cover OPEX, right? To cover operating expenses. It's kind of just the way that the world works, right? You're getting this thing and you're going to use this thing to keep the thing going, right? You're selling your Bitcoin back to keep the wheels turning. Just curiosity, let's live in a world where Bitcoin goes to 200,000. This is not a price prediction. This is a hypothetical situation. If Bitcoin goes to 200,000 at the end of 2025, what does that change anything? As people then compare, because it's almost gone up 50% basically from where it was in 2023. I mean, are there things that people should keep in mind? Because you were talking about the W-2 miner, right? The person who has their W-2 job and they take some money on the side and they invest in some hosted mining with Compass, right? And you said maybe they make 120 a year. Okay, that's the hypothetical. Well, Bitcoin, if it goes from 100 up to 200 by the end of 2025, will they be then taxed in a different bracket because of that income, because of that, the amount of Bitcoin that maybe could be coming in? Could you touch upon that? Because I think that this is interesting. And you asked about the profile of people who mine with Compass. From one miner, that's our minimum order quantity, up to we have clients with hundred to thousands of miners, right? So it could be something that's kind of a main business line for people. It could be something that's basically, maybe they live up in Massachusetts where I am and the electricity is so expensive, but they want to have hash rate up online. So talk about how, as we look forward, once again, hypothetically, if the Bitcoin price continues to rise, what are some things that maybe people should be keeping in mind as they think about their taxes, especially if they are jumping tax brackets?
Short answer, yeah, you can definitely jump a tax bracket. Longer answer, as you noted, price is going up. Guess what else is going up? Difficulty. And what's going down is if you're that single miner, sort of handful of miners being hosted, your share of hash rate in the overall pool is going down as well, likely. And so, yeah, it's not that you're having a 1-to-1 increase in your income necessarily, right, over time. So I don't think it's room for panic necessarily. Like, oh my gosh, wait a second, I need to run around like a chicken with my head cut off. I'm going to be all in tax trouble. It's a bit of a smoothing that happens there, just given with the difficulty. So, but yeah, definitely you could jump a tax bracket for sure.
Yeah, and the reality is you do probably have a larger profit than you would have in this year. So now, even with the tax bracket jump, have you assessed that? Are you prepared for it, right? I mean, the safe harbor to the ships in the storm is perfect, right? Because we can't tell you how many clients we've had to us come in March. Hey, I had a great year, liquidated some, made more than I ever have. And then we hit them with, well, you have this very large tax payment to the IRS, and some of those taxpayers already spent their gains, right, on improving their lives, whatever, reinvesting in their business. So you need to be prepared for that. So you're not just, oh, now I have this huge bill, I don't even have cash ready to pay it. You want to get ahead of that. It's probably the other big point.
Maybe one more sort of wonky thing that's a little bit in the weeds, talking about the tax brackets, right? Just reminder, it's progressive. So once you trip that tax bracket, you're paying, that higher percent on that additional income. And then there's the long-term capital gains rate, right? Hold it 365 days plus 1 before selling. Now you get the long-term treatment, right? Like roughly 20%, which is a significant difference than some of the higher tax brackets. So this is one of the conundrums that miners are going to have when they're thinking about tax reporting is what methodology, what accounting methodology are they going to use? Which is, HIFO on the one case, let's say you're turning over Bitcoin, you're turning over mined Bitcoin pretty frequently. You're selling from your highest in. That's the first going out when you sell. That's going to minimize your cap gain, but it's also more likely going to, it's going to be less likely that those tokens sold off the ledger or out of your tax bases are going to be the older lots of tokens. So you're less likely to get the long-term treatment. Whereas, if, for instance, you're selling periodically, let's say you're not actually selling Bitcoin to cover hosting costs, you're just saying, hey, that's part of my additional sort of cash investment in my business, and you're holding Bitcoin in inventory, then probably a FIFO approach is something to look at, or you're at least going to want to compare them, right? Because FIFO is sort of a default, first in, first out, and that would mean your oldest mined Bitcoin. When you sell, it's looking back in your ledger to your oldest mined Bitcoin. And so that could definitely result in a higher overall capital gain, but a lower taxability on that sale. So you kind of want to look at both of these approaches side by side.
And that's where I'm going to push people to check out the blog and the original episode, because you guys get into all of these acronyms that are very tax specific to people's strategy as they're looking at this.
Check it out. It's not just an SEO blog. We actually did sort of like a full treatise and touched on a bunch of things. So check it out.
And I think, Noah, this is a good segue, right, to get your housekeeping in order as part of the year-end planning, right? So Noah's laying out all these scenarios of maybe you could have a longer-term treatment on a certain sector of your Bitcoin in specific wallets. So to make those decisions, right, you need to have the history of your wallets, your exchange accounts, mining pool reports. Start pulling those together now if you haven't already, because that's what you'll want to have in front of you when you meet with your CPA or your tax team to go over, all right, what strategies could we employ here? What does the full picture look like so we can make informed decisions?
On our last episode, we had on Jeff Bryant. He runs facilities for Compass out in Ohio, and I was able to get out to Ohio this year, only for a couple days for Compass stuff, and was able to meet Jeff and go see the facility. And Jeff and 2 other Compass employees have started a program called Sats for Soup, where they take some of their personal mining profits as individuals, even though they work for Compass, and they basically take a chunk of that and they go to Costco and they buy a bunch of soup and they buy a bunch of other canned goods, perishable goods, and then they go to their local food bank and food pantry and they drop these things off. That is my segue into what are things that we should be thinking outside when we're thinking of our taxes for 2024, where we can maybe lower our tax burden. That would be what I've just segued there was charitable contributions, but what are some other things that maybe people should have in line aside from their mining pool information, aside from their wallet information, charitable deductions? What are some other things that miners can, whether they've got 1 or they got 1,000, can start to consider?
Yeah, the charitable one's a good one, and I'll call out, they were buying goods specifically to donate, which is great. But you can also make direct Bitcoin contributions, right? And you'll get the actual full value of the Bitcoin when you make the charitable deduction. So, talking in that scenario where Bitcoin's up even at 100 now or 200K, that's going to be definitely something for those who have enough, right, that they're willing to part with some of the Bitcoin. That's always going to be a good one. And I'll call out one other thing there is once the value's over a certain dollar amount, and Noah, keep me honest, but I'm not exactly sure the updated figure for 25, but there is a valuation that may need to be done. It's basically an additional tax form for that charitable contribution over a certain amount.
Yeah, exactly. Yeah, larger donations. Bitcoin, relatively easy to value, very liquid market, very global market. Other tokens almost certainly need to be valued, but anything that gets over, I'm going to miss it now. We're so focused on the data and not always the specific numbers in the tax rules all the time, but I think it's roughly 6K, I think 5 to 6K, right? Going over that, you're basically looking at a third party valuation, which is unfortunately the kind of thing you pay people like us, where you pay a CPA firm or a valuation firm, anywhere from $1,000, couple $1,000 to do a formal report. But it is part of the record keeping requirement, and one of these things that, if you're gonna get the tax benefit of making a very large donation like that, you got to kind of also pay the piper to get the right documentation to make sure that you've backed that up really well.
And then I think moving on to other deductions, right? There's depreciation is the first one that comes to mind. And this is specific, obviously, to the Bitcoin miners mining as a business, or even the individuals that have moved beyond the hobby phase. But essentially, any new miners purchased in the 2024 year could qualify for bonus depreciation, right? So it just means you can take a larger chunk of the depreciation expense to offset some of that income, which will bring down the taxable income. Again, everyone's individual circumstance beyond just the miner's purchase is something they'll want to consider, but that'll be one area you could look at to strategize over.
That's an area that we beat up a lot in the prior discussion too, right? Like look at the show notes for that prior call, because we went into, sort of individual versus business, and bonus depreciation sounds great under the 2017 Tax and Jobs Act, but what if you then sell a miner a year or two later? There's an impact for that too. So there's a lot of detail there, but check it out.
Yeah, I think that this episode is kind of an add-on to that first episode. And so make sure you check out that first episode. I think we wanted to record this just as a reminder to Bitcoin miners, to individuals that, hey, it's a great time to even start considering your 2024 taxes, even though we're not even finished 2024, just so by the time you get to the spring, you get to April 15th isn't a surprise. You have everything in order and you kind of know where, know what's going on, right? You have your ducks in a row. With that said, I want to give each of you the chance to kind of say or share something that you think is going to be really, really important or maybe often forgotten. And I'm kind of putting you on the spot here, but what is that one thing for Bitcoin miners? If you ran into a Bitcoin miner and they're like, oh, you work at the network firm. Okay. You guys are like, a firm that's dedicated to supporting cryptocurrency, Bitcoin, blockchain-backed ecosystem taxes, which I think, right now the network firm is probably one of I think you guys are probably the biggest, but like in the future, I can see a world where every single major city has a couple people that are trying to do the work you guys are doing. Maybe not now, but the point being, if somebody runs into you and they're like, oh, wow, this is great, I actually have 3 miners, maybe give that one piece of advice that you think people could really use, because some of the things that you've outlined here, I think actually take a lot of work, right? Just looking at the list, it's like, make sure you have the history of your mining pool reports. I don't know if everyone has that. A history of exchange accounts. Those are normally fairly easy to pull. They're in your tax, wherever you have an account, there's going to be a tax section where you can easily download a PDF, right? And I do that every year and I send it to my CPA. But history of wallets, that can get kind of crazy, especially if maybe you're getting paid out. Some are mainnet, some are Lightning. Depreciation schedules. There's a lot of stuff here. So just a tip from either of you on things that people can really look out for. It's the end of the year. What are your 30 to 45 second tips? Nick, I'm going to pass you the mic first.
You stole my thunder there, because I always go to mining pool reports first with miners. And the reason is that, in my experience, and I'm not sure if this has changed yet to date, but a lot of the mining pools will not keep the history beyond a certain time frame. And some of those are shorter than 1 year, where, it's December, you go to pool them and you can only get back to June or May. And so I do always start there. I think the exchanges have gotten better, where you typically can get that history of between, a year or beyond. And then your wallets, obviously, those don't typically have any history cap. So usually you're okay there. So it's the mining pool reports I definitely key in on, especially for businesses, because that's going to be kind of your main source of support for revenue. And it goes beyond just your taxes, right? If you have audits or internal accounting, those reports are huge. So I really encourage people, the record keeping aspect, it's tedious. It's definitely the least fun in assessing your picture, but you're going to want to get all those reports in order. And the sooner you pull them, the better.
Mine's a little bit more of the season than an evergreen sort of recommendation, and it's to tack on this new tax rule going into place. So the IRS has a new reg going into place. It's called 2024-28, as the IRS loves to just put numbers on things and think people will remember it. Think of this as the by wallet or by account tracking rule. And this goes into effect next year. So at least before you file in April, or if you're a delayed filer, maybe you've got some K1s or other things coming in, you file in April. So you've got a little time technically. In order to capture this safe harbor concept again, you're going to need to do this by January 1st, 2025. And yes, unfortunately, Jarrett, you're right. It's more work, but it relates to allocating unused basis from all of your wallets. And this is going to take a second to explain. I'll try and do it in a nutshell. But most of us think about and or have reported our taxes in a universal way, right? Like, I've got this old wallet I tried. I got this keep key at a conference 1 year, and I fired that up and put some Bitcoin in it. I've got a MetaMask that's got, I forget how many different addresses and networks, right? So you've got all these EVM addresses. Let's say you're just a Bitcoiner. You've at least got, right, like, you've got an Ordinals wallet probably that you're trying on your laptop. You've got old hardware wallets. So you probably have multiple accounts, right? You got to allocate the unused basis to those accounts, or think of them as individual ledgers, basically. So when we think about them now, you probably think, oh, I'm selling some Bitcoin. I sent some Bitcoin from whatever wallet. It doesn't really matter, to Coinbase or Kraken to liquidate to cash, let's say, right? I sold some Bitcoin. In history, we've been thinking, well, it's universal. So when I go to track my taxes, I'm doing highest in, first out, or first in, first out, whatever. So it's going to take the highest purchased Bitcoin, highest value purchased Bitcoin across all of those wallets, right? And dispose of that and calculate the tax impact. Now the IRS is saying, no, you need to do it by wallet. So for instance, if you're selling in that Kraken example, you're going to liquidate some money to buy Christmas presents for the family, whatever it is. You're going to liquidate some Bitcoin. Let's say you do that out of sort of an OG wallet that you mined from, right? And it's very low cost basis Bitcoin. One good thing is it's probably long-term capital gains, but you're going to have a very high capital gain on that transaction, as opposed to I sold it from sort of my daily messing around, sending sats to people type wallet, where your cost basis is likely turned over and quite a bit higher. And so the reason, like, sometimes understanding the reason is important, because, like, why does IRS care if I'm treating these as little individual ledgers or one holistic ledger? Unfortunately, they care because they're trying to align this with the broker-dealer rules that are going into place next year as well, which basically says that Bitcoin that you sent to Kraken now has to report something called a 1099 DA, or digital asset, which will Kraken be telling the IRS directly, this is the proceeds from that sale of Bitcoin in 2025. It'll also tell you, they'll have to send a form to you. Like you said, in the tax center, you'll be able to download, hey, here's my 1099 DA for the year, just like a 1099B that you'd get from Schwab or Fidelity or whatever. It's going to be the same concept. And so the problem is that in 2026, they actually are going to need to report the capital gain and loss as well. So the IRS is basically trying to front run this a little bit and get everybody organized by account. So for instance, if you bought on Kraken and you sold on Kraken, it's all within the same wallet or account. Kraken knows the cost basis. They know the disposition and the proceeds. They can do the whole tax report, right? In my prior example, Kraken doesn't know, right? You just sent OG Bitcoin into Kraken and sold it. They have no idea what you bought that for. And so in 2026, they will have no way to actually mark the capital gains. So they'll just be calling them as outliers, like proceeds without a known basis, essentially, is what's going to probably happen. Well, IRS wants your tax report to match up with that. And unfortunately, or fortunately, whatever it is, IRS does have some very old, but some pretty good reconciliation tools. So they do look right now, if you think about the 1099B securities world, you're trading stocks or whatever on Robinhood or wherever, you're going to get that 1099B. They're pretty good at matching that up with your individual tax return, which is your Form 1040, and reconciling. That's one of the areas where they can throw flags essentially for audit. So it is important. It's super annoying to think about this, but it is important to do it. Hopefully the Bitcoiners only case is a little easier than some of my Solana friends, who are like all over the place with stuff. So yeah, there's a lot there, but that's something to unpack. Take a few days over the holiday, go to your crypto tax ledger software that you're using. If you are not confident in that, reach out for help. January 1st is not the absolute drop dead, but it is a very important day if you want to get this safe harbor, which means if you misreport everything in 25, you at least aren't going to get the penalties piece. So yeah, spend a couple days in your crypto tax software, try and reconcile it. Remember what you sold to buy soup and give to charity, and remember what sats you sent, all this kind of stuff. Yeah, got to get it organized.
Well, I was hoping to not have more anxiety after the call than I did before, but you just gave me it because I bought on an exchange and then I put it in cold storage, and I know when I sell back, I may not be using that same exchange. And so what you've just talked about is the nightmare that I will be in. And so I'll probably be hitting you guys on Telegram, as people should be hitting you guys up for tax support. Where should people find you? I know I can call it the networkfirm.com. Wherever they see this, if you're listening to this on a podcast platform or YouTube, make sure you check out the episode description. But is it cool if I think last time I put your emails in the episode description, other places that people can find you, LinkedIn?
Sure. And a catch-all to make sure that you can get a hold of us is client care at the network firm too. Happy to, Jocelyn will help make sure we get those emails. Happy to take them directly as well. The networkfirm.com, like you said, our door is always open. There's a schedule a call feature there, so people can just kind of come right on in at a time that works for them. And then we also, on this last topic, we've started a YouTube channel recently just to try and do more thought leadership and discuss these topics. And so we did a deep dive on that last topic, 2024-28. So if folks want to go a little deeper on that one or feel like they need to, no one wants to, right? But if they feel like they need to, go ahead and check it out.
I don't know. No, it sounds like you want to. I will go ahead and I'll tag you guys as well with YouTube. I actually love when companies or guests have YouTube because YouTube is Google. So if you're searching for anything, it's really important that you have a YouTube presence because it will just come up, especially if you're using the right tags.
It should be able to come right up. Sweet. Like, subscribe, comment for more great content, right? I got it memorized.
And he was a YouTuber, a man made to do YouTube. Nick and Noah, thank you for hopping on. If you're watching this on YouTube, please subscribe, like, and comment whatever Noah said there. Listen on podcast platforms, please go ahead and subscribe as well. Make sure you're following us on X, YouTube, and LinkedIn at Compass Mining. And Nick and Noah, thank you for taking the time once again.
It's always fun, Jarrett. Thanks.
Yeah, thanks, Jarrett.